and get started. I'd like to say thank you, everyone, for taking time out of your day to attend this presentation. My name is Corbin Granger, and I work in Towne Benefits Compliance. And today we're going to be talking a little bit about the Patient-Centered Outcome Research Institute fee, also known as the PCORI fee. We'll talk about what it is, how much it is, how to calculate it, and then we'll just walk through the form. This really isn't a very long webinar. You will get a copy of the slides. This is recorded, and we will post this on our website as well. So to get started, we always start with our disclaimer, which is things are always subject to change if the IRS, DOL, HHS, or any law changes. So just keep that in mind. Also, this information, we're not attorneys or lawyers. So if there is something that comes up that's a specific question that's not related to the form or what you can find in the instructions, I encourage you to reach out to your attorney or tax specialist. So what is the PCORI fee? The PCORI fee actually applies to an institute in Washington, D.C. It was funded under the Affordable Care Act, and it's called the Patient-Centered Outcome Research Institute fee. And so the institute's goal is to develop and implement things that can make our healthcare better. So an example I like to use is, I don't know if anyone remembers years and years ago, if you had a knee replacement surgery, you were in a cast for maybe 6 to 8 weeks, and then they discovered that, you could possibly never be able to use your leg or your knee quite effectively because atrophy had set in. So now they get you up and moving really almost right away. And the idea is the same behind this institute. The fee is due to sunset after October 1st, 2029, but because it is funding a government vehicle, I think it will probably be around in some shape or form, if not called the PCORI fee, but something else for many years to come. It's due annually on Form 720. Now that is a quarterly excise tax return. So if this is your first year doing the PCORI fee, you'll notice that there's a lot of things on that excise tax return. And you probably don't deal with arrows or fishing rods or petroleum tax or all sorts of other excise taxes. And so I'll go through the form, but they didn't create a new form. They just plunked the PCORI fee right in the middle of the quarterly excise tax return form. And so it's due in the second quarter of the plan year ending in the prior year. So it's due by July 31st of 2024, and that's for all plan years that ended in 2023 that are subject to the fee. So who is subject to the fee? Only certain employer plans pay the PCORI fee. The PCORI fee is paid by self-insured level-funded health plans, and that includes minimum essential or MEC plans. So for example, if you have an Anthem ABF plan, Optima Business Edge, All Savers, Trustmark, Allstate, those are what's called self-insured level funded health plan. And you may wonder, well, why do we have to pay the fee? And the reason is, under the law, the government or the IRS considers the employer the health issuer. So it's almost as if you are the insurance company. So you would pay the fee for that plan. You will also pay the fee if you have what's called an integrated health reimbursement arrangement, or an HRA, with a fully insured health plan or a self-insured level funded health plan. But in the case of a self-insured or level funded health plan, you're only going to file for the self-insured health plan as long as the HRA has the same plan year. So let me back up for a second. Let's say you have a fully insured health plan with Anthem, and you have a $1,000 HRA that will reimburse employees up to $1,000 before they meet their deductible. You will only, as an employer, pay the fee for the HRA because that's considered self-insured. Anthem actually pays the fee on behalf of the fully insured plan. If you're self-insured and you have an HRA, you're only going to pay the fee for the self-insured plan. That way, you're not paying two fees. You're not paying a fee for the self-insured plan and also for the HRA. The other types of health reimbursement arrangements to which it apply are qualified small employer health reimbursement arrangements, or QSEHRAs. Those are available for employers that are not considered applicable large employers. They don't have group health plans, but they give their employees money to help pay for medical expenses and, in certain cases, premiums. An individual coverage health reimbursement arrangement called an ICHRA, same idea. You're giving your employees money to actually pay for individual health premiums. There are many, many rules around both of these arrangements, but they are both considered group health plans and are subject to the reporting for the PCORI fee. Now, how is the fee calculated? The fee is calculated based on a concept called the average number of covered lives. So there's 4 ways to calculate the average number of covered lives, and I'll go through those in just a moment. And you multiply it by the fee that applies for that year. See, every year, HHS increases the PCORI fee just a little bit to adjust for inflation. And they change the PCORI fee every year in October. So if you have a plan year that ended like January through October 1, 2023, then you're going to pay $3 per covered life. If your plan year ended, October 31st, November 30th, or December 31st, you'll pay $3.22 per covered life. And when we go through the form, you'll see on the form that those amounts are highlighted on the form, so you don't have to guess anything. The lines are separate. And here I just put in a chart because we like to give you these presentations so that you could look at them later on. And so here's the chart. So it shows you that anything, all of the plan years that apply for the $3 fee goes through September 30th, and the $3.22 is October, November, and December. So here we're going to discuss briefly how you count the average number of covered lives. And this is for your self-insured or level-funded health plan. There's a different way to count for your HRA. When you're looking at your self-insured or level-funded health plan, you're going to be counting for all the individuals covered. So not only your employee, but their dependents, their spouses. When you're looking at an HRA, it's called one life per participant. So you're only counting the individual employee. So there are, as I said, there are 4 ways. The first way is what we call an actual count method, and it's exactly like how it sounds. You add the number of covered lives on every day of the plan year, and you divide that by the total number of days in the plan year. It sounds simple, but it's probably the most amount of work because you're going to have to count every single day of the plan year. So one of the next 2 methods is generally the most popular. One is called the snapshot count, and the other is called the snapshot factor. So the snapshot count is exactly how it sounds. You're taking a snapshot on really 4 days during the year. So you're going to look on 4 days during the year at how many people are covered. So that's going to be the employee, the dependents, and the spouses. And those 4 days are going to be divided per quarter. And then you divide that by the number of days used, which is going to be 4. So I put the examples down there. So you could use, the first month of each quarter, the second month of each quarter, or the third month of each quarter. And those would correspond to what falls within the plan year. Now, excuse me, I usually recommend, because the count has to be on roughly the same day, it's easiest the way the bills come out or the funding reports come out, to use maybe the first day of the month or the last day of the month. So if you were calculating January, April, July, October, maybe look at the last day of the month. And so I'm going to show you an example here on the next page. The font size here isn't so perfect, but you'll get what I'm saying. So the first quarter, so let's say, for example, this is a calendar year plan. So it starts January 1, 2023. Maybe you count January 1, maybe you count January 31st, but they're 50 covered individuals in that month. Then in the next quarter, you have 45. July, you have 60. October 1st, you have 50. So you're going to add all 4 quarters together, which is 205, and you divide that by the number 4, which is 51.25 average number of covered lives. And then you're going to put the fee for the plan year. Now, let's say, for example, your plan year began in October of 2022. Then you would do October 1st or October 30th of 2022, excuse me, January 1, 2023, April 1, 2023, July 1, 2023. So all of the dates, whether you're choosing the first, second, third, or fourth quarter, just have to fall within that plan year. Now, some bills or funding reports, I do happen to know, for example, Optima, Business Edge, if they're still doing it the same way, they give a monthly funding report, and they don't give you the number of lives covered. They do it by tiers of coverage. And so that's good for the snapshot factor method. So if you're using the snapshot factor method, what you're going to do is you're going to do that same methodology. So you're going to use a date in one of those same 4 quarters, and you're going to count the people that have self-only coverage, and then you're going to count the number of employees that have dependent coverage. And for the number of employees that have dependent coverage, that's multiplied by 2.35, and then you add them together. So assuming the same facts as the slide before, let's say on January 1st, the plan had 25 self-only participants, and it had 12 that had dependent coverage, right? So you're going to take those 12 with dependent coverage times 2.35, and that gives you 2820. You add the 25 plus 2820, and that gives you 53.20 for the month of January. You then repeat that for the other 3 quarters and divide by 4. And so that's a very good method depending on how your bills come in or how your funding reports come in, whether it comes in based on lives covered or tiers of coverage. Either one works pretty well. The last method is probably the least popular for a number of reasons. First of all, if you only offer individual coverage, which none of our clients do because of the ACA, you would take the number of participants at the beginning of the year and the number at the end of the year and divide by 2. For group plans, you all offer coverage other than individual, so you'd have to take the number of participants reported on the Form 5500 at the beginning of the year, plus the number reported at the end of the year, and you don't divide by 2. This only applies to companies that file a Form 5500. If you're wondering, well, what is a Form 5500? That only applies if you have 100 participants or more at the beginning of the plan year. So if you have 25 participants on your plan, you don't file a Form 5500. So this method wouldn't even apply to you. If you do have 100 or more participants and you do file a Form 5500 and you want to use this method, the Form 5500 has to be filed on time by July 31st. So if you're getting an extension, it's not permitted. But that is one of the 4 methods. So you've got the actual count, you've got the snapshot count where you're counting number of lives on 4 snapshot days, or snapshot factor, and you're counting those with self-only, those with dependents times 2.35, adding that together and then dividing by 4, or the Form 5500 method. And so those are the 4 ways of counting. Now, to help you, some of the different carriers or TPAs, they do it a little differently. Optima uses a monthly funding report, and they do indicate the tiers of coverage. So it's easy enough to pull those reports for those months that you've chosen. United Healthcare, they're sending out a membership report by month, calculating the average number of covered lives. They told me that this is due in the first week of July, though on the portal, the UHC services reports level funded, you may be able to pull it there. Cigna, you can go to your employer portal, you go to reporting, government, CRA. Cigna calls it the Comparative Effectiveness Research Fee. That's why it says CRA. CRA report, date range, run report. Trustmark sends a letter showing the average number of covered lives, and Anthem doesn't really provide anything, so we'd have to pull the bills, look at the covered members, and calculate it that way. There are, as I mentioned, special rules for counting health reimbursement arrangements, and it's actually very easy. So when you're looking at an HRA integrated with self-funded coverage, remember, if your self-funded plan has the same plan year as your HRA, then you're only using the calculation that applies to the self-insured health plan. So in other words, you're going to use that method. You're going to count all of the members. This way, you as the plan sponsor are only paying one fee for the self-insured health plan and the HRA. You're not doing 2 separate calculations. If you have an HRA integrated with fully insured health coverage, then you have an HRA, but the health coverage is fully insured. You're going to pay the fee for the HRA, but you're only using 1 life per participant. So in other words, you're just going to count each employee enrolled in coverage on those days if you're using the snapshot. Really, I guess you would use the snapshot count method. You would just count the number of employees enrolled in the HRA in any of those 4 days in any of the each quarters. So you're not including spouses and dependents. If you have a standalone HRA, so a qualified small employer HRA, a QSEHRA, an individual coverage HRA, and ICHRA, that's the same thing. You're just counting the 1 life per participant using the different months in the quarter for the plan. So you're not including spouses and dependents. So let's move quickly to completing the Form 720. We did have to change the date of the webinar because the IRS was extremely late in putting out the revised Form 720. They didn't do it in time for the June 12th webinar. It came out right before then, but it wasn't enough time to put the presentation together. So that's why it was rescheduled. And I'm sorry if that was of any inconvenience to anyone. But this is an 8-page, as I said, it's an 8-page excise return. And we're only completing a very small section, and we're completing it for the second quarter of the year. So the pages that we want to think about are page 1, which is your taxpayer information, page 2, your PCORI fee section, page 3, you're calculating the final tax, and then the payment voucher at the end. So here's page 1. You can see you put in the employer name, You do put in quarter ending. You're going to either put in the current year, June 30th, 2024, or just say second quarter. If you put in the quarter for last year, they're going to think you're filing it a year late. Then you put in the street address, your employer identification number, city, state, zip, and you're going to go to part 2, which is actually on page 2, and it's technically line 133. So under part 2, if you see in red line 133, you might wonder, why is there specified health insurance policies above there with the same information? That's because if the plans are fully insured, that's what the insurance company uses. But because you have a self-insured plan, if you notice, it's on line 133, it says applicable self-insured health plans. So that's why I have it in red. And you're going to put in the count based upon when your plan year ended. So if your plan year ends before October, basically September 30th, 2023, on or before September 30th in 2023, it's $3 per covered life. And you put that in column A, then you put in column C the fee, and then you put the tax. If your plan year ended in October, November, or December of 2023, you're going to pay $3.22. So you're going to put the average number of covered lives in A times 3.22. That gives you the fee, and then you put it in the tax column. On page 3, you're obviously going to carry over the total tax from part 2. Complete sections 4 through 9. You should not need to make any calculation unless the only time you would is if on line 7, if you filed a form, if you're filing a form 720X or amending a return, or you happen to overpay your return last year. But really, it should just be a simple, this is the amount of the tax. You go to line 10, that's your balance due, and you sign it. We say you review it to your CPA. Either you sign it or your tax preparer signs it, and then you go to submit it. You can submit it electronically through the electronic tax payment system. You do not have to. You enter the amount. If you want to use the voucher, you enter the amount of the payment. You include the check, and you put in there that it's for the second quarter. If you want to mail it, this is on page 2 of the instructions. I will be sending out, along with the presentation, the instructions and the form, and the address is in page 2 of the instructions. If you want to file it electronically, the information is there and also in the instructions as well. We always say we review it with your CPA or tax specialist. And I always like to remind everyone, Barbara and I have a podcast. We've created that because we get a lot of questions on the same things. Like, what about someone? How long do they have to be actively working before you offer them COBRA? What about an employee says they're being retaliated against, or what do we have to look for? What about FMLA? These are really 10 to 15 minute segments on little HR topics. So if you're walking your dog, if you're driving into work and you want to listen to it, please feel free to. It's on our website, but we're also on Spotify. And we put these out about every third Wednesday. And with that, I'm going to open it up for questions. It really is quite a simple form filing. And I'm going to go ahead and open it up for questions. And I'll go ahead and stop the screen so that, oh, people can see me. Okay. And see if anybody has any questions. So I don't see any questions. So hopefully that means everyone has gotten the information they needed, or if you have a question, feel free to contact your broker, or you can contact me directly. I also hope everyone has a really wonderful 4th of July holiday. I will be out for part of next week, but please feel free to send me a message or your broker a message, and we will be happy to help you. Again, the due date is July 31st of 2024. Thank you so much for attending today. We will be sending out the slides, and we will be having the recording up there. And we will also include the instructions and the tax form. Thank you so much. Have a great day.